Welcome to the Explainer. Let's dive right into the mechanics of buying versus selling options.
So, between buyers and sellers, who actually holds the ultimate statistical edge in the market?
It comes down to a massive statistical mismatch. Option sellers boast a crazy 80% win rate.
Why? Well, buyers need huge price jumps. Sellers just need the price to stay below a set target.
Markets basically move in 5 ways, right? But buyers only win big during massive directional swings. In the other 4 scenarios, like flat or choppy markets, the seller naturally walks away with the cash.
That wildly uneven playing field gives the seller a staggering 80% chance of winning.
To get why sellers dominate, we got to look at the 3 main variables controlling option pricing.
First up is theta. Options are decaying assets, so time just relentlessly eats away their value.
That ticking clock makes time the absolute worst enemy for buyers, but a seller's best friend.
If prices just stay flat, the option expires worthless. The seller sits back and keeps the premium.
Then there's implied volatility, or IV. The coolest thing? Its behavior is actually super predictable.
Think of IV like an elastic band. When you stretch it way out, it naturally snaps back. Sellers completely exploit this. They write options when IV is stretched high, then buy them back cheaper.
Since high IV almost always drops, sellers face way lower odds of losing money to volatility spikes.
So how do writers even fund these trades? Cleverly by using assets they already own.
They literally pledge dormant assets like mutual funds to their brokers to get margin for option writing.
It's an insane capital hack. Your long-term investments simultaneously generate active trading revenue. Pretty brilliant, right?
But wait, if the seller win rate is truly 80%, why doesn't everyone just sell?
The catch is brutal. When you sell an option, you take on absolutely all the unmitigated risk.
One tiny piece of bad news or a random volatility spike and you could lose absolutely everything.
Buyers have to predict, but sellers survive by relentlessly mastering the art of adjusting their positions.
Sellers win 80% of the time, sure, but without strict adjustments, that 20% causes total ruin.
Do you have the sheer discipline to master these adjustments, or will that immense risk entirely consume you?